What is contango and backwardation in commodity investing? Have you ever wondered how the prices of commodities change over time? Understanding the terms contango and backwardation can help you navigate the world of commodity investing. Let's break these concepts down in a simple way. Contango occurs when the futures prices of a commodity are higher than its current spot price. This means that if you want to buy a contract for delivery in the future, it will cost you more than buying the commodity today. This situation creates an upward-sloping futures curve. Why does this happen? One reason is the costs associated with holding the commodity until it is delivered. These costs include storage, insurance, and financing, which are collectively known as carry costs. For example, imagine the spot price of gold is $1,200 per ounce. If a futures contract for delivery in 1 year is priced at $1,400, the market is in contango. Investors need to be aware of this because, when they sell near expiry contracts and buy longer-dated ones, they may face roll costs. This can reduce returns, especially for those investing in commodity exchange, traded funds or funds that continuously roll futures. Now let's talk about backwardation, which is the opposite of contango. In this case, the futures prices are lower than the spot price. This creates a downward-sloping futures curve. Backwardation often occurs when there is a short-term supply shortage or increased demand for immediate delivery. For instance, if the spot price of oil is $50 per barrel, but the 3-month futures contract is priced at $40, the market is in backwardation. Backwardation can actually benefit investors. When they roll futures contracts, they can sell expiring contracts at higher prices and buy longer-dated contracts at lower prices. This generates a positive roll yield, which can enhance returns. Understanding whether a commodity is in contango or backwardation is essential for managing risks and returns. Commodity exchange-traded funds and funds that invest in futures must roll contracts before expiration. The shape of the futures curve directly affects their performance. In a contango situation, rolling futures can lead to losses over time. Conversely, in backwardation, rolling can add to returns. Some commodity funds use specific strategies to navigate these conditions. They may select different contract maturities or employ active management to take advantage of market changes. In summary, contango and backwardation are important concepts in commodity investing. They reflected market expectations, supply and demand dynamics, and the costs of carrying physical commodities. By understanding these terms, investors can make informed choices that align with their risk tolerance and return goals.